When I transitioned to managing the trading floor in Chicago, man, did I see more than I ever imagined when it came to trading trending stocks in the office. One of the toughest things to recognize in trading is when a trade shifts from being capitulatory into something that is sustainable and not what you initially envisioned. Way too many people give up P&L fighting the trend on steady moves only to be scared out of trading the real opportunities and setups within mean reversion. The trauma from fighting the trend is real, and it can get out of hand real fast. As we always said, crazy can get crazier and the market can stay irrational for longer than you can stay solvent. When I first started trading and learning from my trainer, this was one of my group's biggest weaknesses. We weren't paying enough attention to how a stock was moving and how it was covering ground, while overweighting the simplistic view of how big the move was or how many percents it was up. In fact, I still see way too many traders overweight the percentage amount of a move far too much compared to how it got there in the first place. After taking some massive losses, we eventually learned our lessons and came to realize some big epiphanies in what would later develop into my framework for trading capitulations. So that begs the question, what were the key lessons we learned? In essence, it was identifying what variables led to unsustainable price action versus what could continue indefinitely. Let's take a look at this chart of Ford. Initially, off the opening flush from $11 to $10.65, I could see how one could get sucked into fading this, especially being such a big move for this ticker. But this chart is actually the opposite of what I want to see. Why? We started off fairly interesting, as I mentioned, with a pretty aggressive downward slope. But as each bar progresses, they are starting to get smaller and more intentional. By 9:40 a.m., the slope really levels off, and essentially this becomes price acceptance. You can see this by the volume flattening off and steadying compared to the surge off the open. Nowhere did price truly waterfall lower or volume capitulate higher. This comes back to adaptability and dynamic expected value. You have to constantly be recalculating your odds. In something as boring as Ford, what looked promising to start has become steadily weak as the market soon accepts new prices as the equilibrium. This is important to me because something like this is what I have no interest in when looking to trade a reversal. Sometimes it's about knowing what characteristics don't work and what you want to stay away from to avoid taking a trade you shouldn't. Now, let's contrast that Ford chart to this intraday chart of LIFW. This stock opens on the stronger side and around 9:50 a.m. has a reasonably sustainable slope, probably about +1 up and to the right. It's not until about 10:18 a.m. that we start to aggressively capitulate, not only in price action, but also in volume. Not only are these bars multiples bigger than the previous ones, but we move far away from the moving average and Bollinger Bands in a very short period of time on exaggerated volume. The move up to $2.70, unlike the prior trend, is not sustainable. When we compare it to a steady slope of 1, this is going euphoric to the upside and stretching like a rubber band prone to snap back. It's no surprise that afterwards, we saw a big reversal back towards and then below the moving average. Perhaps the best example I can give to demonstrate this point is the 2 consecutive days in AVGO during May of 2023. The intraday charts are back-to-back, but could not make for a more perfect contrast for this discussion. On May 26th, we gap up, but proceed to be steady strong off the open. The slope is roughly 1, and if anything, the bars are getting smaller, and we spend virtually no time above the upper Bollinger Band or stray too far from the moving average. I remember seeing FinTwit in a panic when all sorts of people were fading the move short and getting run over. Those losses are totally preventable when you can learn to recognize this framework. We held that steadiness all day, and based on my framework, there was zero reason to ever be short this day. This chart is the definition of steady strong and something you would never ever want to be caught fading. Now, let's contrast that with the following day on May 30th. The ticker opens strong, we have a few small bars, and then we really take off to the upside. The slope of this line is steep and gets even steeper as time progresses. The bar size is accelerating and the move is so sharp we capitulate far above the upper Bollinger Band and incredibly far above the moving average. This is a euphorically and unsustainably sharp move. Like I said earlier, this doesn't mean that crazy can't get crazier, so you still need to have a system in place to capture reversals like this. The first step in doing so is having a framework of qualifying price action. Is it neutral, consolidating price acceptance? Or is it steady strong or maybe steady weak? Is it capitulatory strong or capitulatory weak? Side tip number 1, the implications for this concept aren't just for avoiding losses or fighting trends. This also applies to positions going in your favor. In general, I want to try my best to ride the trend as long as it is steady and consistent. But the more capitulatory the trend becomes, the more eager I am to lock in profits. Side tip number 2, don't forget that these same concepts apply to any time frame. Even though the analysis shown above was done on intraday charts, it applies to daily, weekly, or even monthly charts all the same. In other words, we will go deeper into capitulation trading and mean reversion strategies, but this should be a basic lesson of what sustainable versus euphoric looks like. I'm going to assign some homework for you to apply the concept and learn to master it. What I recommend you do is make a game out of flipping through charts and categorizing the price action. Is it in a period of consolidation, or is it strong, is it weak? Or maybe it's slightly strong, or euphorically strong. Over time, it will become second nature to process charts this way, and it will help your trading immeasurably.